Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update. Big news, PCE came way higher than expected, and personal income and personal spending also came hotter than expected. Personal income came 0.6, and previous one was 0.3, and personal spending from negative 0.1 to 1.8, showing signs that US consumer is spending and spending and spending. PCE price index month over month came way higher than expected, 2.0 to 0.2 to 0.6, and year over year we are still this high. And core PCE price index year over year also came way higher. We were expecting a deflation and a decrease, and we got more than the previous one, 4.7. So what do you think Fed will interpret from this data? Well, basically that personal spending is way higher than normal and prices are way higher than they desire. So they will continue hiking interest rates like always. So apart from the 25 basis points, let me tell you, we are starting to see a spike 30% for 50 basis points, and the probabilities already are pointing towards 550 and some crazy percentages with 550, 575. And even some analysts are starting to think about 5.5s or even 6%. So this is just the beginning. Inflation is still there from CPI, from retail sales, from PPI, now from PCE. I mean, this is looking pretty bad. Sticky inflation is a big problem for the US economy. New home sales month over month came as expected as the previous one, and new home sales slight increase even though we are at high interest rates, but home sectors still hot. Consumer sentiment 67 way higher, and expectations 64 way higher. 5-year inflation expectations 2.9, and look at this. Inflation expectations final from 3.9 to 4.1. So consumer sentiment is looking good. I don't know why US consumer is still having this kind of sentiment when basically prices are still skyrocketing. Well, how the markets reacted? Markets reacted in a pretty bad way. This is when PCE came out, we basically sold off, we did a double bottom. I was expecting this kind of bounce, and I missed the short at 12,050. This was a big opportunity to the short side to ride the momentum down. But let me tell you, I'm quite disappointed of this kind of price action. I think the issue is that at that point into the open, we were already 1.60 in the red. So basically since open, we are right now 0.16, only that, but the fact that during pre-market we were so bearish, it's the reason why we are not selling off bigger. But well, still a lot of volume down here. This is looking like a V-shape volume profile. That means long liquidation. I don't think shorts are adding, it's just the people that were taking these kind of opportunities. If we check the 5 minutes, the people that were at these levels is basically being liquidated. So this is a big point actually. If this area in the 2-hour time frame, we can see that it was resistance here, it was support here, we did a wedge, we did a false breakout, nice Wyckoff upthrust into this resistance to take momentum to the downside, and we are actively selling off. Also, this pivot that I was saying this morning in the market forecast, I'm looking this pivot. I'm looking yesterday's, come on trading view. I'm looking to this pivot. Yesterday's, come on trading view. I'm looking to this pivot. Yesterday's low with this V-shaped reversal that we got based on 0 days to expiration options. This was manipulated to the upside and we are right there. So that's the reason why I was looking for shorts at this level. I missed this opportunity. I took some other shorts with this after this double bottom pre-market breakdown, couple of scalps. But I think from a bearish point of view, this is holding better than expected. It's true that Nasdaq is 2% in the red. Yes, S&Ps are 1.30 in the red. Apple 2%, Microsoft 2%, Tesla 3%, Amazon 3%. I mean, everything is in the red. The only thing that is in the green is dollar, as always. Look at this, building momentum. We reached our target. We are at 105 because basically money is rotating into cash, into Forex, and dollar is one of the most liquid assets in the US stock markets. So 2-year is also, look at this. This is the reason why we have to be afraid. 2.72% in the green for the US 2-year yield. The 10-year is also spiking. We were forecasting this in today's video this morning. If you didn't check that out, please check that out. Super interesting to see how I interpret these markets. Really recommended. And look at this. This is September terminal rates with 5.41. We reached 5.44% interest rate in September, and December is looking similar. So bonds market are increasingly pricing in higher risk of interest rates. This is going to explode, let me tell you. Look at this inversion. This is the 10-year minus the 2-year yield curve. We've been following this trend since 2021. We inverted. This is the blue line that marks 0% inversion. We bounced and we started going inverted on July last year. And since then, we've been doing lower lows, lower highs. We rejected on December and we are finally breaking down this pivot that is super important. We tried to do this bounce, but this was, I think it was a trap. It was a misunderstanding of the bonds market. But look at this. This is not misunderstood. This is going lower with momentum. 2 big red candles, same as this one. And this is showing that the US economy is really, really sick. This inversion is pretty important. If we check, this is the weekly chart, we have not been so much inverted as the current time. This was 2000 crisis, this was 2008 great financial crisis, this was the pandemic, and this was the 90s. So let me tell you, this is some historic yield curve inversion. This is something no one has ever seen. And not only this yield curve is inverted, the shorter term, the 2-year minus the 3-year, is almost reaching, is bouncing out, because this is basically going to interest rates, terminal rates. And the 10-year minus the 3 is also going green. The one that the Feds are watching is this one, the 10-year minus the 2-year. The 2-year, the shorter term one, is controlled by the Feds, and the 10-year is controlled by the markets. And this is telling us that something is really sick, and most probably we are going into a recession. Believe it or not, I think media and government will try to change the rules to say the word recession, but I think this is more than enough to see that we are in a recession. We are going to be in a recession this year. We will see about next year, but what is true is that I think right now, as of today, after last week economic data and this week economic data, no one is really hoping for a Fed pivot this year. Feds are not going to cut any interest rates this year, and bonds market agrees with that. Finally, we are consolidated at these levels. This is a change of sentiment, and this is something you have to really understand for the midterm. If you are investing or you are trading these markets, there's something that has changed today. And this was what I was looking for. Resolution of this bear flag, trying to retest this level and going down. We will see if we find support on the close here or if we close above this 200. But if we close right now or even lower, next week is going to be a bloodbath. So this is my interpretation. I really think we are starting a new era, and you have to be prepared, because even though the markets are not selling off too big, everything is red, and everyone is starting to realize that this economy is switching to a new sentiment, and you have to be prepared for that. Last thing I would like to mention, as always, is take a look to the kind of rotation on the sector funds to see if we can see some sneaky rotations from the big players. So this is the 1 day. Utilities up there, staples, industrials, and consumer discretionary and technology are there. So as you can see, the defensive sectors are doing better than the other ones. And I think on the 2 days, it would be, let me check the 5 days. Staples, utilities, financials, industrials, and consumer discretionary to the downside. It's obvious that in times when interest rates are so high, energy is going to be smoked, technology, communications, and also consumer discretionary is going to suffer because of demand destruction. So this makes sense, and I think is one of the things that make you understand really how big hedge funds rotate their cash, their investments into defensive when they see big problems, when they see underlying issues on the economy. And right now, after all these 2 weeks of economic data, this is what I think is the market sentiment. Is just we are going to pull back and we are going to correct, because we are not ready yet to claim that inflation is going down. We failed here, and economic data just shows us the real situation, the reality. This is a reality check. So be careful next week. Be careful next week. So as always, thank you for your time. If you found this video useful, please remember to click the like button and subscribe to the channel to support the channel and to receive notifications when I upload new videos. I upload new videos every single day for market forecast, market updates, and market recap. I appreciate your time as always. And remember, the trading day is not over yet. Discipline and risk management are key for success. Take your profits, enjoy your weekend, and see you on Monday. Stay safe, everyone.